Welcome back to the channel. In a quarter where many expected headwinds, one energy giant is not just weathering the storm, it's beating expectations and rewarding its shareholders handsomely. We're talking about Exxon Mobil. Today, we're breaking down their blockbuster third quarter 2025 earnings, explaining what drove the success, and most importantly, what it means for your investment portfolio. Let's dive in. Exxon Mobil Corporation, ticker XOM, is one of the world's largest publicly traded international oil and gas companies, engaged in every facet of the energy industry. Its core business is the exploration, production, transportation, and sale of crude oil, natural gas, and petroleum products. This integrated operations model spans a massive global upstream segment, which finds and extracts hydrocarbons, and a downstream segment that includes refining, manufacturing and marketing fuels, lubricants, and high-value chemical products. The company also has a significant chemicals division that manufactures and sells petrochemicals. With a vast global footprint, Exxon Mobil leverages its advanced technology, extensive infrastructure, and large-scale operations to deliver energy and chemical products worldwide, making it a dominant and influential player in the global energy market. First, let's get straight to the bottom line that every investor cares about: the numbers. Exxon reported a net income of $7.5 billion, or $1.76 per share. Now here's the key takeaway. That result beat Wall Street's adjusted earnings estimates. Analysts were looking for $1.82 per share, and Exxon delivered. But the real story of strength is in the cash flow. The company generated a massive $14.8 billion in operating cash flow and $6.3 billion in free cash flow. This is the engine that powers everything else. And where did all that cash go? Straight to the shareholders. In just 3 months, Exxon returned a staggering $9.4 billion to its investors. That includes $4.2 billion in dividends and another $5.1 billion in share buybacks. And the good news for income investors doesn't stop there. The company just announced a 4% dividend increase for the fourth quarter, bringing it to $1.03 per share. This marks an incredible 43 consecutive years of dividend growth, solidifying its status as a true dividend aristocrat.
So how did they achieve this? It all comes down to exceptional operational execution. The company hit a record production of 4.77 million barrels of oil equivalent per day. 2 regions were the standout stars: the Permian Basin, right here in the U.S., and offshore Guyana. In fact, the Yellowtail project in Guyana is a perfect example of their efficiency. It started production 4 months ahead of schedule and under budget. That is a remarkable feat in this industry. They also benefited from higher refining margins, meaning they made more money turning oil into gasoline and other products, thanks to global supply disruptions. But perhaps the most impressive long-term story is their relentless focus on cost-cutting. Since 1919, Exxon has achieved over $14 billion in cumulative structural cost savings, with $2.2 billion saved in this quarter alone. They are well on their way to their goal of over $18 billion by 2030. This makes them more resilient, even when oil prices are down. Now, let's address the elephant in the room. Yes, year-to-date earnings are down compared to the record highs of 2024, mainly due to lower commodity prices. However, this earnings report shows that Exxon is not just a passive player waiting for oil prices to rise. They are actively creating value through volume growth, project discipline, and serious cost control. For investors, this paints a picture of a company that is financially robust, committed to returning capital, and strategically positioned for efficient growth. Exxon Mobil has delivered a quarter that demonstrates strength, discipline, and a powerful commitment to its shareholders. It's a compelling case for anyone looking for stability and income in the energy sector. Let's look at the bull case, the reasons for optimism around Exxon Mobil. The company is hitting record production levels in its most crucial regions, the Permian Basin here in the U.S., and its massive projects off the coast of Guyana. This isn't just about pumping more oil. It's about positioning the company for significant revenue growth and improved profit margins. And all that production is translating into a torrent of cash. Exxon is generating strong free cash flow, and that gives the company incredible flexibility. This cash is funding a very attractive dividend, currently yielding around 3.5%, and consistent share buybacks. For income investors, that's a solid foundation.
But Exxon isn't just resting on its laurels. The company has been on an aggressive cost-cutting mission, delivering meaningful structural savings. In a world of volatile oil prices, that cost discipline is a crucial shield for their earnings. They're also strategically investing in the future, advancing high-return projects like the Yellowtail development in Guyana, while also putting capital into lower-emission initiatives like carbon capture and hydrogen. Now, let's flip the coin and look at the very real challenges and risks. The biggest factor, as always for oil and gas, is commodity price volatility. Oil prices are under downward pressure from OPEC+ production increases and ongoing uncertainty about global demand. This directly impacts Exxon's near-term earnings and can spook investors. We're also seeing that revenue growth has slowed considerably. Some recent quarters have even shown year-over-year declines. The days of explosive post-pandemic growth are likely over. It's not just about the price of crude. The refining and chemical segments are facing margin pressures, and potential changes in U.S. tariff policies could further raise costs or disrupt their trade patterns. Add to this a broader macroeconomic backdrop of uncertainty and geopolitical tensions, and it's easy to see why investor sentiment can be fragile. From a technical analysis perspective, some indicators are pointing to short-term bearish momentum, signaling we might see some price fluctuations or a pullback before any sustained rebound. And while the cash flow is strong, some argue the stock's valuation and profit margins still have room for improvement, especially as the global energy transition introduces long-term risks. Let's talk more about dividends. Exxon Mobil isn't just maintaining its dividend, it's consistently growing it. The company recently declared a 4% increase in its fourth quarter 2025 dividend, bringing it to $1.03 per share. Why is that a big deal? Because this marks 43 consecutive years of annual dividend increases. That's over 4 decades of rewarding shareholders, regardless of oil price swings. This incredible streak places Exxon Mobil in an elite group of S&P 500 companies known as dividend aristocrats.
But a long history is one thing. The ability to pay is another. This is where the financials come in, and they are rock solid. The key metric here is the payout ratio, the percentage of earnings paid out as dividends. For Exxon, this sits at a very comfortable around 57%. What does that mean? It means the company is using just over half of its profits to pay dividends, leaving a huge cushion to reinvest in the business and weather any downturns. This isn't just based on earnings, it's backed by immense cash flow. In the third quarter of 2025 alone, Exxon generated a massive $14.8 billion in operating cash flow and $6.3 billion in free cash flow. That's the cash left after essential investments. This cash flow powerhouse is what makes the dividend so secure. Dividend safety metrics rate Exxon Mobil's reliability incredibly high, with a score of 0.99 out of 1.0. That's about as safe as it gets. This prudence isn't new. The company has navigated brutal commodity cycles by focusing on cost-cutting and smart capital management, ensuring the dividend remains stable. For you, the investor, this translates into a forward dividend yield of approximately 3.6%, which is very attractive in today's market. Let's put this track record into a historical perspective because it's truly staggering. Exxon Mobil has paid dividends for over 100 years. Let that sink in. Through world wars, recessions, and booms, it has never missed a payment. If we zoom in on the recent growth, you can see a smooth, consistent upward trend. The quarterly dividend has climbed steadily from about 87 cents in 2020 to the new $1.03, averaging a reliable 3 to 4% annual increase. So, to answer our initial question, is Exxon Mobil's dividend safe? The evidence overwhelmingly points to yes. It's not just safe, it's one of the most reliable dividends in the entire market. With a sustainable payout ratio, fortress-like cash flow, a top-tier safety score, and a track record that spans over a century of payments and 43 years of increases. Exxon Mobil stands as a cornerstone holding for any income-focused portfolio. The consensus rating for Exxon Mobil is a moderate buy. This isn't a screaming, unanimous buy, but it's a very strong and confident vote of support. Where's that coming from? Well, based on 20 recent analyst ratings, 10 recommend buy, 10 recommend hold, and importantly, we see several of those being strong buy endorsements. What's almost nowhere to be found? Sell ratings. That tells you something about the floor analysts see under this stock. So, what's the potential upside? The average 12-month price target is around $127.58. With the stock currently trading near $115, that implies a potential upside of roughly 10.5%. And for the real bulls out there, the most optimistic price target goes all the way up to $156, suggesting some analysts see very significant growth on the horizon. The analyst community is fundamentally positive. They view XOM as a favorable long-term investment that offers a compelling mix, a reliable, high-yielding dividend, strong operational health, and a clear path to valuation growth. The moderate buy rating is a signal that it's a stock to consider for building a resilient, income-generating core position in your portfolio, rather than a speculative high-risk bet. It's a play on stability, income, and steady, analyst-backed growth. That's our breakdown of Exxon Mobil. Do you agree with the moderate buy rating? Are you bullish or bearish on XOM? Let us know in the comments below. And don't forget to like and subscribe for more clear, concise stock analysis. Thanks for watching.